This is the macro show. This is pregame, okay? We're trying to play the game that's in front of us today. You know, leadership matters at Hedgeye. So again, being transparent, accountable, and trustworthy people. This is a game about playing and weighing probabilities. It's not about picking stocks. It's about picking the right portfolio.
This is something we track pretty religiously. This is retail traffic. So just traffic trends at retail, lower lows, lower highs. The reading we pulled out this Wednesday, they come out every Wednesday morning, hit an all-time low. People just are not shopping anymore. That's probably not a fair statement. People are shopping, but they're shopping to a lesser extent than they did at this time last year. And this is all about rate of change, and I don't think rate of change is going to be getting any better. And mind you, these retailers in the next 2 to 3 weeks who are putting out numbers are going to be guiding towards this kind of traffic rate. So they've been kicked in the teeth for the past couple of quarters, you know, taking down numbers by a nickel, a dime, a quarter. Now I think they're going to really take down numbers to a really large extent, and I think that's something that you really want to be focused on. Even a couple of the winners out there on this next slide, you can see Ulta, which is a best idea short of ours. Point of just accountability, transparency. I've been short this since 400. The stock's now at about 5. So I've been wrong on it, but traffic is cracking. It is absolutely cracking. It's not immune to the consumer. This is a name I don't like. It's a best idea short. I think that the earnings algorithm is going to really deteriorate in the back half of this year, potentially when I go bullish on other more like crap retailers. So you see this flow of funds going from Ulta, which is like the ultimate safety stock right now because beauty has been so strong during the reopening. And the company put in new brands in its stores last year that drove comp. It put in a 5% price increase that drove comp. Now they've got an anniversary, all of that. At the same time, Kohl's is putting Sephora shop-in-shops inside their stores. They'll be 80% done by the end of this year with that rebranding. And mind you, Sephora is owned by LVMH, which might be the best company in the world. It certainly isn't consumer discretionary. You do not want to mess with them. I'm not saying that all of Ulta's traffic goes over to LVMH, but all you need is 5% and boom, you get a price war going on, and that takes margins down. That's a decelerating pod 1 on top of a decelerating pod 2 on a name that still trades at 20 plus times earnings. So we're short that one. I would press that one like right now. Let's go through the consumer rundown a little bit here. I hit on this last time I was on the macro show. I hit on it at Hedgeye Live. This is just something I really look at a lot, which is the savings rate, because consumption accounts for what, 73% of total GDP, and consumption, the big buffer to consumption is how much people are not spending and they're taking and they're putting away in their savings accounts because they're afraid of losing their jobs. It troughed out in June of last year at 2.7, now it's up at 4.6. And it's probably headed higher, particularly if you heard what Steiner said on the call this morning and he said on the macro show yesterday about us being in a very unfavorable point in the job cycle, which is something that you've got to take very seriously. Skip this next slide, go to slide 22 here. You know, the consumer's levering up. And it's just unmistakable. Even if you want a straight line where we were pre-pandemic, you look at 2019 levels, we're trending above that. This is about a 2-month-old chart because this data comes out on a lag, but I'd suspect that those numbers are going higher. And these are the absolute balances on these cards. What we don't see in this chart is that the rates on those cards are so much higher. So basically, if you go to Kohl's and you go shop on your Kohl's card, you're paying an interest rate in the high 20s, which is just absolutely ridiculous. I think as far as the department stores go, on the short side, we're short Macy's, we're short Nordstrom, we're short Dillard's, we're short Canadian Tire, CTC.A. This company put out numbers yesterday and credit started to crack. So your next shoe to fall here is credit. A lot of these retailers, credit income accounts for upwards of 100% of their total EBIT. And people ask on the conference calls about what product is selling, if people like stripes versus solid colors. It's all bullshit. It doesn't matter. Credit matters. That's what you got to focus on, and that's the first line I look at as these companies put out numbers.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.